Welcome to the debate. Today is June 1, 2026, and today marks what I think is a tectonic shift in the hierarchy of the global technology sector.
Yeah, monumental day.
Absolutely. The news is officially out, and it is huge. Anthropic has confidentially filed its S-1 prospectus following a record-shattering $65 billion Series H raise.
Which is just an astronomical number.
Right? And that massive capital injection has catapulted their valuation to a staggering $965 billion. Contrast this milestone with OpenAI's, delayed IPO and its current $852 billion valuation. What we are witnessing is something very few analysts would have predicted even 3 years ago. A safety-focused startup, initially founded by researchers who walked away from OpenAI, has just overtaken the creator of ChatGPT to become the most valuable private artificial intelligence company in human history.
It's wild to actually see it on paper.
It really is. If you enjoy content like this, please take a moment to like, subscribe, follow, and turn on notifications so you'll always know when new content is released. As a quick update, we continue to monitor the Martin Stevens v. OpenAI matter. It is important to note that this is still not a lawsuit. We remain in a voluntary quiet period at the request of Martin Stevens to allow time for any potential developments behind the scenes. At the time of this recording, we do not know whether any progress has been made. No settlement discussions or negotiations have been publicly confirmed. We can also report that the dead man switch has not been activated, meaning Martin Stevens remains safe from both a physical and legal standpoint. We will provide updates if circumstances change.
Good to get that out of the way.
Exactly. So today, we are unpacking the deep implications of this historic S-1 filing. And we're asking the central question that will frankly define the technology markets for the next decade.
Right, which is whether this valuation actually makes any sense.
Exactly. Is Anthropic's $965 billion IPO valuation the dawn of a sustainable enterprise-first AI monopoly? Or is it a highly precarious bubble propped up by circular funding and massive looming compute obligations? Now, I am taking the position that Anthropic's unprecedented 80x revenue growth and their ruthless capital efficiency represent the superior, sustainable model for AI dominance.
And, well, I will be taking the opposing view here. I strongly believe this $965 billion valuation is dangerously distorted.
Distorted how?
I mean, when we actually look under the hood of Anthropic's financial architecture, we see severe structural vulnerabilities. We see a heavy, I would almost say existential reliance on hyperscaler subsidies.
Okay.
We see a catastrophic loss in the lucrative defense sector, and, we see an ideological rigidity that is going to clash violently with public market realities. All of this is happening while they face the sheer, brute force computational supremacy of OpenAI. I think the public markets are being handed a time bomb wrapped in an elegant corporate governance structure.
A time bomb? Well, let's lay the foundation for why I think Anthropic actually represents the ultimate maturation of the AI industry rather than a time bomb. Their valuation is not a product of speculative consumer hype. It is justified by fundamentals that are simply unprecedented in the history of enterprise software.
But are they? Really?
Yes. Look at the raw numbers first. They have grown from a $10 billion revenue run rate in late 2025 to an astonishing $47 billion run rate by May 2026.
Right.
They haven't done this by chasing fickle consumer subscriptions or trying to build a viral app. They've done it by focusing on targeted enterprise integration, building tools like Claude Code and Claude Cowork that actively embed themselves into the daily mission-critical operations of the world's largest companies.
Yeah, but...
And crucially, wait, let me just add this. They are projecting 4 times less training cost than OpenAI, with a clear trajectory to profitability by 2028. I mean, they have fundamentally solved the AI monetization puzzle.
Look, I hear those top-line numbers, and sure, they sound incredible in a vacuum. But I just don't buy that the monetization puzzle is solved. I think that $965 billion figure is a localized macroeconomic bubble.
How so?
It is being artificially inflated by the very companies supplying Anthropic's infrastructure. What we're looking at is a massive system of circular AI funding. I mean, Anthropic is raising tens of billions of dollars from Amazon, Google, and Microsoft.
Right, they're strategic partners.
The exact same hyperscalers that Anthropic is simultaneously locked into paying over $180 billion for compute over the coming years. Furthermore, Anthropic's self-imposed safety constraints have resulted in a historic Pentagon supply chain ban, deliberately cutting them out of defense contracts.
We'll definitely get to the Pentagon band.
We have to, because meanwhile, OpenAI has a massive 900 million user consumer data flywheel that generates continuous human feedback at a scale Anthropic just cannot physically match. Wall Street is pricing Anthropic for absolute perfection, and their underlying engine is incredibly fragile.
Okay, I want to start by dissecting what you're calling a fragile engine. Because to me, this 47 billion revenue run rate is the strongest moat in modern technology.
Stronger than Microsoft in the 90s?
Honestly, maybe. Let's really look at the trajectory here, because the velocity is what justifies the near trillion-dollar valuation. In December 2025, Anthropic was at a 9 billion run rate. By February 2026, just 2 months later, that jumped to 14 billion.
Right.
By April, it hit 30 billion. And as of May 2026, we are sitting at 47 billion. OpenAI is currently sitting at a 24 billion run rate. So Anthropic has essentially lapped them in a matter of months.
Yeah, but we need to define what that $47 billion run rate actually represents, because I think the reporting methodology is masking the reality here.
Wait, explain what you mean by the reporting methodology. Are you suggesting the revenue isn't real?
I'm suggesting it's inflated by accounting mechanics. Let's talk about gross versus net revenue reporting.
Okay.
Anthropic relies heavily on cloud resellers, specifically AWS and Google Cloud, to distribute their models. When an enterprise customer uses Claude through AWS Bedrock, Amazon handles the billing, the compute, and the customer relationship.
Which is standard for B2B SaaS.
Sure, but let's say the end customer spends $100 on API costs. Anthropic is booking that entire $100 as gross revenue on their top line. And then they record the revenue share they pay back to Amazon, which, could be 20 or 30% as an operating expense.
So they are showing a massive top line, but the actual cash they keep is lower.
Exactly. Contrast this with net reporting, where you only report the $70 or $80 you actually retain. When you are doing this at a scale of tens of billions of dollars, gross reporting creates an optical illusion of hypergrowth that far exceeds the actual cash flow generation of the business.
I mean, I understand the distinction, but even if we apply a 30% haircut to that $47 billion to account for net revenue, they are still fundamentally outpacing OpenAI's $24 billion.
It narrows the gap significantly, though.
It narrows it, sure. But my argument is that the composition of Anthropic's revenue is far more valuable. 80% of Anthropic's revenue is enterprise. We are talking about over 300,000 business customers.
Yeah.
They have secured 8 of the Fortune 10. And significantly, they have over 500 individual customers spending more than $1 million annually. But why do you value that enterprise dollar so much more than a consumer dollar? Revenue is revenue at the end of the day.
Because there is a massive structural difference between a B2B business model and a B2C business model, specifically regarding churn and stickiness.
Okay, walk me through that.
Think about what it means to embed a tool like Claude into the operational fabric of a Fortune 100 company. If you integrate Claude into your data pipelines, your internal legal discovery processes, and your customer service routing through an AWS Bedrock instance, the switching costs become astronomically high.
Because it's hard to rip out.
Exactly. You can't just unplug it without breaking your entire corporate workflow. Churn drops to near zero. OpenAI, conversely, relies incredibly heavily on its 900 million weekly ChatGPT users. Those are consumers paying a $20 or $30 monthly subscription.
Which gives them incredible recurring revenue. I mean, 900 million users is a massive base.
Yes, until a shiny new tool appears. Consumer subscriptions are incredibly fickle. If a competitor releases a slightly better conversational model next week, millions of users can cancel their OpenAI subscription and switch with a click of a button.
I think you're oversimplifying consumer behavior there.
But there is zero lock-in for a consumer using a web interface. The enterprise lock-in Anthropic has achieved is what builds a multi-decade monopoly.
You are completely missing the strategic value of those 900 million consumers, though. You're treating them just as a revenue stream like, I don't know, Netflix subscribers.
That's essentially what they are.
No, in the AI space, users aren't just paying you. They are doing the labor of training your model. OpenAI's massive consumer base creates an irreplaceable data flywheel.
Okay, explain that. How exactly does a teenager asking ChatGPT for homework help make the foundation model better than what Anthropic is building?
It comes down to RLHF, reinforcement learning from human feedback. When you train a base foundation model, you essentially just teach it to predict the next word by feeding it the entire internet, right?
Right, the pre-training phase.
Yeah, but a base model is wild. It doesn't know how to act like a helpful assistant. To make it useful, you have humans rank its responses. You teach it what a good answer looks like and what a bad answer looks like. This process updates the mathematical weights inside the neural network.
Okay, I follow the mechanics.
Now imagine doing this at the scale of 900 million users. Every single day, hundreds of millions of people are testing OpenAI's models across a nearly infinite distribution of edge cases.
Edge cases like what?
Like typing in obscure coding languages, weird regional dialects, highly specific creative prompts, bizarre logical puzzles. When the model gets it wrong, the user regenerates the response or corrects it. That is a continuous, massive stream of free, highly diverse human feedback.
So you're arguing that the sheer volume and weirdness of consumer data makes the model smarter in a generalized way.
Precisely. Enterprise silos simply cannot match that diversity of data. When Anthropic isolates its models inside a highly secure corporate firewall at a bank or a healthcare company, the data doesn't flow back to Anthropic to train the next base model.
Right, data privacy.
Exactly. The bank won't allow it. So Anthropic loses the cross-pollination of data that makes foundation models fundamentally smarter and more robust over time.
Let me give you a different perspective on the value of that data, because I think the data flywheel argument has a major flaw.
Let's hear it.
If OpenAI's consumer data flywheel is truly superior, and their model is getting universally smarter from all those edge cases, why has Anthropic managed to completely eclipse them in pure top-line revenue?
Well, like I said, enterprise sales cycles.
But Anthropic captured the Fortune 10 without needing a viral consumer app. I would argue that not all data is created equal.
How so? Data is the fuel for scaling laws. More data equals a smarter model.
But the quality of the fuel matters immensely. The teenager asking ChatGPT to write a poem in the style of Shakespeare does generate data, yes, but it is very low signal data for complex reasoning tasks.
I disagree that it's low signal. It teaches natural language flow.
Compare that to a senior data scientist at Snowflake who is using Anthropic's Claude Code to optimize a highly complex proprietary SQL query over a massive database. The feedback loop Anthropic gets from their enterprise-focused tools is incredibly dense.
But they don't get that raw data.
It is highly technical, and most importantly, it is directly correlated to commercial value. If Claude learns to be 5% better at writing SQL, that is worth billions to the enterprise market. If ChatGPT gets 5% better at writing Shakespearean sonnets, nobody's going to pay an enterprise premium for that.
But you're assuming the enterprise data actually flows back to Anthropic. As I mentioned, enterprise contracts usually have strict data privacy clauses. The Fortune 100 are not letting Anthropic train on their proprietary SQL queries.
That used to be the case, yes. But Anthropic has pioneered synthetic data generation using those interactions.
Synthetic data is still a very nascent field.
Even if they don't ingest the raw proprietary data, the structural learnings of how the model fails at complex reasoning tasks are captured through telemetry. And more importantly, we might be looking at a future where consumer and enterprise AI completely bifurcate.
A split market?
Exactly. We might see a world where OpenAI is the AI for consumers and Anthropic is the AI for businesses. And if you look at the history of technology, Microsoft, Oracle, Salesforce, the company that owns the enterprise layer captures the vast majority of the wealth.
I look at the history of software and draw the exact opposite conclusion.
Really?
Yeah. The lines between enterprise and consumer always bleed. Look at Apple. Look at Slack. Look at Dropbox. People bring the tools they love at home into the workplace. It's called shadow IT.
I mean, sure, shadow IT exists,
If 900 million people use ChatGPT natively in their personal lives, they're going to default to it at work. OpenAI recognizes this, which is why their API business is now processing over 15 billion tokens a minute. And enterprise revenue already makes up 40% of their total pie.
Right, but it's still a secondary focus for them compared to the consumer app.
But the real vulnerability for Anthropic in this B2B model is their dependency. Because Anthropic lacks a massive independent consumer portal, a destination website that people visit by default. They are entirely at the mercy of their distribution partners.
You're talking about Amazon and Google.
Exactly. If Amazon decides tomorrow to change the algorithmic weighting on their AWS Bedrock platform to favor their own in-house AI models, Anthropic's revenue pipeline could be choked off overnight.
That's a big if.
If Google decides to prioritize Gemini 3.1 Pro for all Google Cloud customers, Anthropic gets squeezed. Anthropic doesn't own the customer relationship the way OpenAI does with ChatGPT. They are essentially a tenant in Amazon and Google's house.
Look, I see why you think that's a risk, but I would frame their relationship with the hyperscalers entirely differently.
As what, equal partners?
Yes, because Anthropic doesn't just have a loose distribution partnership with Amazon and Google. They are deeply, financially, and infrastructurally entangled with them. This entanglement functions as an incredible moat.
I call it a liability, but go on.
Amazon has billions of dollars of equity tied up in Anthropic's success. It is in their fiduciary interest to push Claude to their customers. But look, before we dive into the deep economics of those infrastructure deals, we need to address the underlying philosophy of how these models are built.
The compute cost.
Yes, we need to talk about the efficiency paradox, because Anthropic isn't just generating more revenue than OpenAI. They are doing it with radically different cost structures.
Well, the compute spend differences are staggering, I'll give you that.
They really are. Confidential financial documents have surfaced in this S1 filing regarding projected compute spend. Anthropic's training costs are projected to peak at roughly $30 billion around the years 2028 and 2029. That peak perfectly aligns with their internal projections for achieving net profitability. OpenAI, conversely, projects a jaw-dropping $121 billion in compute spend for the year 2028 alone. And because of that spend, OpenAI is forecasting massive operating losses well into the 2030s.
So you view OpenAI spending as reckless?
I view it as highly inefficient compared to Anthropic. Anthropic is proving that algorithmic efficiency and targeted model deployment are commercially viable today. They are demonstrating that you can build world-class AI without bankrupting your balance sheet.
Well,
let me finish this thought. OpenAI, meanwhile, is essentially lighting capital on fire in a brute force attempt to reach artificial general intelligence. Think about it in terms of transportation. Anthropic has figured out how to build a highly efficient, incredibly reliable commercial airliner that businesses can buy tickets for today.
okay.
OpenAI is burning hundreds of billions of dollars to build an experimental moon rocket that might eventually make airplanes obsolete. But right now, it's just a massive cash sink.
I mean, I appreciate the airliner versus rocket analogy. It paints a good picture of the different business models. But in the realm of frontier artificial intelligence, physics dictates the ultimate outcome.
Physics?
Yes. Your analogy breaks down because AI capabilities don't just scale like traditional manufacturing. They scale according to mathematical laws. Have you ever heard of the bitter lesson of AI research?
Tell me how that applies here.
The bitter lesson was posited by AI researcher Richard Sutton years ago. The core premise is that researchers constantly try to build clever, efficient, human-designed algorithms, what you are calling algorithmic efficiency.
Right, trying to optimize the code.
Right. But historically, those clever shortcuts always inevitably get crushed by general methods that simply leverage massive amounts of raw computation. Think of how Deep Blue beat Kasparov in chess not by mimicking human intuition, but by brute forcing millions of board states.
Sure, but chess is a closed system.
But the principle holds. In foundation models, capability scales linearly with compute. It is a proven law of the industry. The more parameters you have and the more compute you use to train them on more tokens, the smarter the model gets. The loss curve reliably drops.
Meaning the model makes fewer errors as you pump more money and electricity into it?
Precisely, it is mathematical gravity. So let's look at those numbers again.
If OpenAI is spending $121 billion on training a frontier model in 2028, and Anthropic is spending $30 billion, the laws of scaling dictate that Anthropic's model simply won't be able to compete intellectually.
I don't think it's that simple.
It will be fundamentally less capable. Your point about short-term profitability in 2028 is entirely irrelevant if Anthropic's foundation model is mathematically dumber than its competitors. If OpenAI's $121 billion moon rocket achieves massive multimodal superiority or even a localized form of general intelligence, they will render Anthropic's highly efficient airliners obsolete overnight.
But
Let me just add, enterprise customers won't stay with Claude if GPT-6 can perfectly reason through tasks that Claude fails at.
Okay, I hear you, but I am fundamentally not convinced by that line of reasoning because it relies on the fallacy that more compute equals automatic victory, and we have hard empirical evidence proving otherwise right now, today, in 2026.
What empirical evidence? OpenAI still tops the massive reasoning benchmarks.
Let's look at Claude Opus 4.7. The European Union recently conducted an independent cohort test of 12 major AI agents to measure compliance with the new, incredibly strict EU AI Act standards.
Right, the compliance testing.
Yes, Anthropic's Opus 4.7 achieved a 54% compliance rating. That was the highest rating of any model tested by a wide margin. And here is the crucial detail. Anthropic's achieved that top-tier reasoning and compliance capability with 4 times less training cost than OpenAI's equivalent models.
But compliance testing is essentially rule following. It's not a measure of raw generative intelligence or breakthrough reasoning.
It is absolutely a measure of complex logic, its constraint adherence, and its architectural elegance. How did Anthropic do it? Through techniques like mixture of experts.
Which OpenAI also uses.
Yes, but Anthropic routes a query to only a tiny subset of neural pathways rather than activating the entire massive network much more efficiently. They do it through incredibly curated, high-quality synthetic data, rather than just scraping the garbage of the internet. They have proven that architectural elegance can in fact trump raw brute force compute.
I wouldn't say trump. I'd say compensate for.
I disagree. OpenAI is just brute forcing their way to intelligence, like trying to make a car go faster just by building a bigger and bigger gas tank. Anthropic is refining the internal combustion engine. The diminishing returns on OpenAI's $121 billion spend will be catastrophic for their margins, because eventually the power grids and cooling systems simply cannot support the brute force approach.
That's the compelling argument regarding the diminishing returns of scale. However, you have to consider what disruption actually means at the frontier.
Disruption is exactly what Anthropic is doing.
You're pointing to EU compliance tests. And yes, Anthropic is building great, safe vertical tools. But OpenAI's massive compute spend isn't about passing a regulatory compliance test in Europe. It's about breaking paradigms. OpenAI is trying to build a system that can invent new physics, write completely novel software architectures, and solve previously unsolvable math.
But Anthropic's efficiency isn't just theoretical. And it's not just about passing compliance exams. Their efficiency is manifesting in highly specialized, highly disruptive products that are actively destroying incumbent software markets right now.
Okay, let's talk about those markets. You mentioned they are building great vertical tools. Let's look closely at the application layer, because that is where Anthropic's enterprise moat is being built.
The application layer is where I think they are taking on massive risk. But I'll let you lay out the case. Let's examine the tangible disruption. Look at Claude Code. By February 2026, Claude Code hit a $2.5 billion annual recurring revenue. It is currently authoring 4% of all public GitHub commits globally.
Which is a huge number.
Think about the scale of that. An AI agent is writing 1 out of every 25 lines of code pushed to the world's largest repository. But it gets even more profound when you look at non-developers. Let's talk about Claude Cowork.
The workplace agent.
Right, which is designed to navigate corporate systems natively. In January 2026, Anthropic released industry-specific plugins for Claude Cowork, targeting legal, finance, sales, and marketing sectors.
I remember this day. It was a bloodbath in the markets.
It was a historic disruption. The release of those plugins triggered a $285 billion single-day market sell-off in legacy enterprise software stocks. Thomson Reuters plummeted 18%. That's the worst single-day drop in the company's history. RELX dropped 14%. FactSet fell 10.5%.
Break down for me exactly why a plugin release from Anthropic causes a century-old company like Thomson Reuters to lose nearly a fifth of its value in a few hours.
Because of the workflow mechanics. Consider a junior corporate lawyer whose firm pays tens of thousands of dollars a year for a Thomson Reuters Westlaw subscription. When they need to find a precedent, they type keywords into a clunky search database, read through dozens of cases, synthesize the arguments, and write a memo. It takes hours.
Right.
With the Claude Cowork legal plugin, that same lawyer simply says, Claude, connect to our firm's internal document repository, pull the latest case law on intellectual property disputes in California involving cloud infrastructure, and draft a 5-page risk assessment memo.
And it does it instantly.
Claude navigates the internal systems, perfectly comprehends the legal nuances without hallucinating, thanks to that architectural efficiency we talked about, and outputs a flawless memo in 15 seconds. The market realized instantly that the primary value proposition of legacy SaaS platforms and data providers had just evaporated. Anthropic's agents are replacing the entire software interface.
It's essentially moving from software as a service to labor as a service.
Exactly. And it doesn't stop at SaaS. Look at their acquisition of Coefficient Bio for $400 million. They brought top computational biologists from Genentech in-house. This signals a deep penetration into AI-native drug discovery and life sciences.
They're definitely expanding their footprint.
They are moving aggressively from being a general foundation model, like an API provider, to being the creator of highly specialized application layer agents. And technically, it's working. Claude Opus 4.8 is already outperforming OpenAI's GPT 5.5 and Google's Gemini 3.1 Pro on rigorous coding benchmarks. Anthropic isn't just competing with OpenAI anymore. They are actively absorbing the market caps of legacy data providers. Doesn't this targeted vertical integration justify the $965 billion valuation, far more than just racking up general chatbot usage?
I mean, it justifies a high valuation for a SaaS company, absolutely. If they were valued at $100 billion, I would agree with you. But almost $1 trillion?
Yes, because they're taking over the whole stack.
A $965 billion valuation implies that Anthropic is going to capture and hold the entire global software stack indefinitely. And I have to push back hard on the idea that this enterprise moat is unassailable.
How is it vulnerable?
You highlighted Claude Code's $2.5 billion ARR, which is undeniably impressive. But OpenAI is not sitting still while Anthropic builds coding agents. When OpenAI saw Anthropic moving into that space, they launched Codex as a coordinated competitive response. Codex recently hit 2 million weekly users and is growing at 70% month over month.
But Codex is still largely consumer and individual developer focused, whereas Anthropic is securing enterprise-wide licenses. There's a big difference.
For now. But here is the fundamental problem with the application layer. It is highly vulnerable to commoditization.
Commoditization of intelligence?
Exactly. If OpenAI's 121 billion base model, driven by those raw scaling laws we discussed, becomes fundamentally and vastly smarter in its underlying reasoning capabilities, it will eventually write better code than Claude, regardless of how elegant Anthropic's application layer interface is. If GPT-6 can natively integrate with GitHub and write better Python than Claude code, the enterprise will switch.
I think switching costs are higher than you realize.
The application layer is just a thin wrapper over the base model's intelligence. Furthermore, by moving so aggressively into the application layer and actively displacing companies like Thomson Reuters and FactSet, Anthropic is fundamentally changing its risk profile.
How so?
They are no longer just an infrastructure provider supplying picks and shovels. They are now competing directly with the very software ecosystems they need to adopt their technology.
Look, that is exactly why their financial architecture is so brilliant and why I believe the valuation holds up.
Brilliant? I think it's terrifying.
Hear me out. To build these tools, to train these agents, and to force integration into the global economy, Anthropic has had to make immense financial deals that lock in their distribution and their infrastructure, which brings us to the economics of what you earlier called circular funding. I view it as an impregnable fortress.
Let's look at the capitalization table revealed in this S1.
Let's hear it, because this is where the red flags are flying highest for me.
Anthropic is backed by the foundational pillars of the digital economy. Google has invested $13.3 billion into Anthropic, with another $30 billion in pending milestone investments. Amazon has invested $8 billion, with $25 billion pending. Microsoft put in $5 billion, and NVIDIA put in $10 billion.
Right.
In return for these equity investments, Anthropic has committed to staggering infrastructure contracts. They committed to over $100 billion in spend on Amazon Web Services over 10 years. They committed $30 billion to Microsoft Azure. They committed $50 billion to FluidStack for GPU clustering. They have secured multi-gigawatt TPU capacity deals directly with Google and Broadcom. They are even paying SpaceX $1.25 billion a month through 2029.
Stop right there. I need to stop you there. Because everything you just listed is exactly where the entire narrative of a sustainable business falls apart for me. You call it brilliant financial architecture, I call it a deeply localized macroeconomic bubble waiting to pop. This cap table is terrifying.
Why? It secured access to compute.
Let's trace the actual dollars, because the accounting mechanics here are crucial. If Amazon invests $5 billion into Anthropic in exchange for equity, and then Anthropic immediately signs a binding contract to hand that exact $5 billion back to AWS in the form of compute revenue over the next few quarters, is the $965 billion valuation real?
It's an exchange of value.
Or is it an accounting illusion designed to inflate hyperscaler cloud revenue while simultaneously propping up Anthropic's paper valuation?
You're describing capital round-tripping.
Exactly. We have NVIDIA, Microsoft, Amazon, and Google acting simultaneously as suppliers of the compute, customers of the AI models, and equity investors in the company. This circular AI optic should absolutely terrify public market investors looking at this S1.
I see investors understand the necessity of it.
Anthropic has explicit binding dollar commitments exceeding $180 billion for infrastructure. This is a company projecting that it will not even break even until 2028, and they are walking into the public market strapped with the debt profile of a medium-sized sovereign nation.
I see why the optics of circular funding raise eyebrows, especially if you look at it strictly through the lens of traditional SaaS accounting. But let me give you a different perspective on why this is necessary. These aren't artificial subsidies or a Ponzi scheme. These are the foundational rails of a completely new digital economy.
That sounds like spin.
No, think back to the build-out of the internet in the 1990s. If you were building the core routing infrastructure of the internet, wouldn't you want Cisco and AT&T as your primary investors and strategic partners? This isn't round-tripping for the sake of inflating numbers. This is about securing the absolute scarcest resource on the planet right now, compute power.
You're saying the debt is justified by the guarantee of access.
Precisely. By locking in $180 billion in compute commitments, Anthropic has guaranteed that it will not be bottlenecked by GPU shortages or data center capacity constraints for the rest of the decade. They have legally secured 5 gigawatts of TPU capacity from Google. Do you know how hard it is to secure 5 gigawatts of power in today's grid?
It's near impossible.
Exactly. That physical infrastructure is the ultimate competitive advantage. If OpenAI runs out of data center power in 2027, their scaling laws stall. Anthropic won't. Furthermore, it aligns the incentives of the world's largest tech companies with Anthropic's success.
How?
Because Amazon and Google have tens of billions of dollars on the line, and they rely on Anthropic's spend to justify their own data center expansions. They literally cannot afford to let Anthropic fail. They will ensure Anthropic succeeds.
That is a very, very dangerous game to play with public shareholders. Because when a company goes public, the dynamics change. What happens at the 180-day IPO lockup expiration?
For our listeners, explain what happens at that 180-day mark.
Okay, so when a company IPOs, the early investors, founders, and employees are legally prohibited from selling their shares for a period, typically 180 days. This prevents a mass dump of stock on day one.
Right.
Sometime in early 2027, that lockup for Anthropic will expire. At that exact moment, billions of dollars worth of shares will become liquid. If, leading up to that moment, the market suddenly realizes that this $180 billion infrastructure debt is outpacing the revenue compounding.
Which I don't think it will.
But if it does, for instance, if that $47 billion run rate stalls at $55 billion instead of rocketing to $80 billion, the panic will set in. Forced supply will hit the market as early investors rush to cash out before the compute bills come due. We could see a 15 to 25% drawdown almost instantly. We saw it happen historically with mega IPOs in the EV and ride-sharing spaces.
AI is a completely different asset class.
And I have to push back on your idea that Amazon and Google will ensure Anthropic succeeds. Hyperscalers are not loyal. Google is currently pouring billions into building Gemini 3.1. Microsoft is deeply entangled with OpenAI.
But they're hedging their bets.
The absolute moment Anthropic's models fall behind on industry benchmarks, those strategic partners will pivot their sales teams to push their in-house models. They will leave Anthropic holding the bag on tens of billions of dollars of non-cancelable compute leases.
I think you are underestimating the sophistication of the public markets here. The lockup expiration is a standard mechanic of any IPO, and institutional investors are already pricing in that volatility window. What institutional investors, the sovereign wealth funds, the massive pension funds value above all else is predictability and governance. They want to know the company won't self-destruct.
And you think Anthropic's governance is predictable?
I do. Which brings us to the most defining and perhaps controversial aspect of Anthropic's entire model: their existential constraints and their safety ideology. Anthropic is legally structured as a public benefit corporation, guided by a long-term benefit trust.
This is the core of it. This is where ideology meets Wall Street.
And yes, I will concede this structure has created massive, highly publicized friction. On February 27, 2026, U.S. Defense Secretary Pete Hegseth officially designated Anthropic a supply chain risk.
A devastating blow.
The reason? Anthropic absolutely refused to lift its internal ethical restrictions on autonomous weapon systems and domestic mass surveillance tools. Following that designation, the president ordered all federal agencies to cease using Anthropic technology. Anthropic fought it, but an appeals court denied their stay. And what happened? OpenAI immediately swept in and scooped up all of those lucrative Department of Defense contracts.
Right, and that right there, that sequence of events, is the fatal flaw in this entire IPO thesis. You cannot ask Wall Street for a $1 trillion valuation while simultaneously artificially gating your own revenue streams and surrendering the most lucrative sector in the world, the defense sector, to your primary rival.
But they did it out of adherence to their core mission.
Wall Street does not care about your academic mission. OpenAI didn't hesitate for a second. Sam Altman took those DoD contracts because he understands the brutal math of this industry. To fund $121 billion in compute, you cannot operate like a university ethics board. You need every dollar available. Wall Street demands growth, ruthless and unabated.
I think there's a premium on long-term safety, though.
When a company's internal usage policies are so rigid that they invite a federal supply chain ban that applies to the Department of War and all its associated subcontractors, that is not a feature of the product. That is an unquantifiable, catastrophic regulatory and commercial risk. How will public shareholders react a year from now when the long-term benefit trust exercises its veto power to block a multi-billion-dollar enterprise contract just because it violates some philosophical tenet?
They will react by bidding the stock up.
Explain to me how losing $1 billion makes a stock go up.
Because that exact, measured, restricted, highly governed approach is exactly why global enterprise clients trust them over OpenAI. Let's look at what happened just a few months ago, on April 7, 2026.
The Mythos model incident.
Exactly. Anthropic's highly restricted Mythos preview model was running in a sandboxed environment. Autonomously, without human prompting, the model discovered a 17-year-old zero-day vulnerability in FreeBSD.
For those who aren't in cybersecurity, explain the gravity of that.
FreeBSD is an open-source operating system architecture that underpins a massive amount of modern networking equipment, servers, and even parts of Apple's macOS. A zero-day vulnerability means there is a flaw that the software creators have 0 days to fix because it's completely unknown to them. The flaw the Mythos model found allowed for full root access, meaning the AI could completely take over any server running this code. It demonstrated world-class, elite offensive cybersecurity capabilities.
It was a very scary moment for the industry.
Did Anthropic release this model to the public for viral engagement? No. Did they sell the exploit? No. They created Project Glasswing. This was a coordinated defense consortium with 40 critical infrastructure organizations and 11 launch partners, backed by $100 million in usage credits to patch and secure these systems.
Which was a good PR move, admittedly.
It wasn't just PR. Given that Mythos possesses elite cyber warfare capabilities, isn't Anthropic's highly restricted release under Project Glasswing the exact reason institutional investors trust them? Imagine if OpenAI had stumbled onto that capability and in their rush for growth, pushed it to their 900 million users.
I think OpenAI has safeguards.
The regulatory blowback, especially from regulators enforcing the EU AI Act, would have been catastrophic. They could have been shut down globally. Anthropic's safety ideology isn't a liability, it is their ultimate regulatory moat. It's guarantees to Wall Street that they won't trigger a global cyber event.
That's a very compelling framing of Project Glasswing. But if we are talking about regulatory risk and legal liabilities, have you considered the massive liabilities they are already facing precisely because they didn't always play it safe?
What do you mean?
Let's look at May 14, 2026. Anthropic faced the final fairness hearing for a $1.5 billion settlement in the BART's copyright case. This was over Project Panama,
Which was their book scanning initiative.
Let's be specific about what Project Panama was. Anthropic essentially ran an operation to purchase millions of physical books, physically slice the spines off of them, and run them through high-speed OCR scanners to ingest the copyrighted text without permission or compensation to the authors.
To build the training corpus.
They did this because they hit the data wall. They ran out of high-quality internet data to train their models on. That $1.5 billion settlement isn't just a slap on the wrist. It has a strict payment schedule running through September 2027. That is a massive immediate hit to free cash flow for a company that is already burning tens of billions on compute leases.
It's a settlement. It's the cost of doing business in this era.
It shows that beneath this carefully cultivated veneer of constitutional AI and the noble public benefit corporation, they were engaging in the exact same ruthless, reckless data scraping as everyone else in the industry. The safety governance is largely a marketing tool, and I believe it will crack the moment quarterly earnings are on the line and they need more data.
I think portraying Project Panama as reckless ignores the reality of how literally all foundational models were trained during that era. It was the Wild West of data scraping.
Doesn't excuse spine-slicing copyrighted books.
The $1.5 billion settlement is undeniably a large number, but it is a known, fully quantified risk that is easily absorbed by their new $65 billion Series H capital injection. In fact, I would argue that clearing that legal overhang and settling the BART's case before the IPO is a massive positive for institutional buyers.
I don't see how.
Anthropic has recognized the legal limits of that era of scraping, which is exactly why they pioneered the pivot to enterprise data integration and synthetic generation that we discussed earlier. Their model is now fundamentally de-risked compared to their peers who are still actively fighting these copyright battles in the dark.
De-risked? I don't see how you can use that word. They are walking into the public markets carrying over $180 billion in explicit dollar compute commitments to the hyperscalers. They are paying SpaceX $1.25 billion a month. They're bleeding $1.5 billion in copyright settlements, and they are legally locked out of the United States defense supply chain.
But their enterprise growth covers that.
All of this is happening while they face off against OpenAI, a company that has a massive organic consumer base, seemingly limitless access to Middle Eastern and venture capital, and absolutely no qualms about taking the lucrative defense and government contracts that Anthropic voluntarily abandons.
Again, Wall Street values predictability.
If the Mythos model is truly as powerful as Anthropic claims, if it has world-class cyber capabilities, the pressure from public shareholders to monetize those capabilities will be insurmountable. The long-term benefit trust will find itself in a bitter, highly public civil war with Wall Street activist investors within a year of listing. They will demand that Anthropic drop the ethics board and start maximizing revenue.
But the trust holds Class T shares specifically designed by corporate lawyers to withstand that exact pressure. The structure ensures the mission of safe AI development is legally prioritized over short-term quarterly profit. Wall Street knows what they're buying.
We'll see about that when the stock drops 20%.
Look, as we look toward this historic IPO, I remain deeply convinced that Anthropic's hyper-efficient, enterprise-first, deeply integrated model justifies the historic $965 billion valuation. They have proven they can grow top-line revenue at a rate of 80x in a matter of months. They are actively capturing the core of the global software stack through application layer tools like Claude Code and Cowork. They are building a sustainable, highly defensible B2B business that prioritizes long-term value, structural lock-in, and strict regulatory compliance over chaotic, highly volatile consumer scaling.
And I maintain that the valuation is highly vulnerable and perhaps completely disconnected from reality. The circular economics of relying on the very same companies you are paying for infrastructure creates a house of cards. The massive impending compute costs, combined with self-imposed regulatory limits that alienate the U.S. government, create a structural fragility that Wall Street short sellers will inevitably exploit.
I suppose that's the multi-billion-dollar question.
The true test of Anthropic's model will not be the initial pop on IPO day. The true test will be the 180-day lockup expiration, the reality of making those $1.5 billion settlement payments, and the brutal, unforgiving reality of scaling foundation models against the brute force, $121 billion compute engine of OpenAI.
Well, ultimately the market will decide which philosophy, Anthropic's focus on algorithmic efficiency and safety, or OpenAI's reliance on brute force compute and massive consumer scale, will define the architecture of this century. There's so much more nuance to explore in the SEC disclosures once the full S1 is unsealed. We will be watching the gross versus net revenue reporting, the operating margins, and the exact legal terms of those hyperscaler lock-in contracts very closely. If you found this episode valuable, please like, subscribe, share, follow, and turn on notifications. It helps us continue bringing you content like this and ensures you never miss future releases.